Hi, friends. I wanted to get on the airwaves today and talk about what is happening in our lending world. With all of the negative fear-based headlines, it's imperative that I give you the real facts. So I have come all the way to Calabasas to sit with my main money man, Mr. John Wade. And unless you've got a bunch of cash in your bank account, without him, you've got nothing. Lending is the biggest piece of the puzzle when buying real estate. A lot of times people like to look at houses before getting their money together. But if you're interested in real estate, this is always your first step. So I welcome Mr. John Wade from Fairway Independent Mortgage. John is not only a broker, but he is a direct lender who's been facilitating loans for 18 years, which means he knows how to navigate all markets. John, say hello to my people.
Hello, people.
So Johnny, tell us how we're going to continue to build wealth in this market, because the truth is that the market is what you make it. Whether we're on a high or whether we're on a low, there's always opportunity, and this is what we're going to talk about today. So as we give our audience the keys to be successful in this market, I want you to start telling me, what is it that the Fed is doing right now to correct where we've been? How bad do you think it's going to get, and how long do you think this is going to last? Keep it real for us, Johnny. Keep it real.
Well, inflation.
Yeah.
Right? I mean, everybody's hearing inflation. Inflation is rapid raising or rising prices, right? And the Fed wants to get that under control. Price stability is key for everything. Because if you don't have stability, it's hard to maneuver markets. It's hard to determine, where to allocate your money, your assets, when to buy and when not to buy. So the Fed is looking to slow this inflation down. And by doing that, they're looking to slow down the economy. Right? The only way you can slow down inflation is you got to stop people from spending. Right? So they're putting mechanisms in place to slow down the economy to bring these rates down.
And it always starts with the housing market, right? Like, isn't this the biggest sector?
Housing is something like 18 to 20% of GDP.
Okay.
So it's a big part of most people's everyday living expenses, right? And so that's a big part of it, right? We've all seen the rapid, appreciation of home values in the past couple of years, and that's part of it. That's not all of it, but it's just a part of it. So I think in terms of where this is going and how long this is going, that's a tough question. A lot of it's probably, I think that we're probably nearing the end of it. Right? I think we're probably getting peak
We're
inflation.
nearing the end of it? Johnny,
well,
what are they trying to do? Because all I'm hearing is like rates are going to 8%, 9%, 10%. So what do you mean when they're nearing the end of it? What does that mean?
Well, I think we're nearing the end of the rapid rate increases.
Okay.
We're probably going to be in a higher rate environment for some time to come, probably through 2020, 2023, in certain cases 2024. We don't know, right? That's the challenge. I mean, the Fed is trying to change behaviors, and a lot of our behaviors are psychological. Right. What do I think and what do I believe? So, we're not really sure.
So to get back to my question about, why they're doing this, they seem to be coming in really strong to like overcorrect the market. Guys, if you thought that 3% loans and $500,000 over asking was going to be sustainable, then you're not paying attention. We knew that this was going to happen. This time, today, and where we're at, it was inevitable for us to get here. So we're dropping back into what I like to call normalcy, because over the past 3 years, it has been absolute bananas. As a real estate advisor of 17 years, I can tell you, me and my colleagues have been jaw-dropped with some of the prices that we've been seeing out there. And how much business? We did so much business last year. What's actually funny is this is the first time I'm meeting this guy in real life. I've been dealing with John for 3 years on the phone. I probably talk to him 20 times a week. And this is the first time we're actually seeing each other in real life. And you look good, honey. You look good. Okay. So basically, just to bring that all back into a summary, we're probably going to see some tightening in the market for at least 6 to 18 months. Okay. We're going to see rates fluctuating and going up. And this is to really correct the market. We're going to see softening. We're not going to see crazy prices like we used to see. Now, there are some products that, depending upon how they're priced and strategized in the market, they are going into multiples. But we are seeing, how many applications do you have going right now compared to where you were 6 months ago?
Yeah, we're about 50% lower. But remember, we had a lot of refinances as well. So I'd say purchase is down about 20%.
Okay. So that brings us into the next question.
But I just want to say one thing.
Yeah.
You said, I think you used the right word. You know, we're maybe looking at a little softening.
Mm-hmm.
You know, there's a lot of headlines out there, you know, where we're talking about market crash.
Mm-hmm.
You know, they're trying to echo 2008,
Mm-hmm.
and you know, we're in a completely different place than we were in 2000.
Why is that?
Well, in 2008, you know, that was a housing bubble that was caused by Wall Street.
Right.
You know, Wall Street really wanted these mortgages. At that time, we had a smaller population base, right? Millennials were no longer home buyers, right? And millennials are now the largest demographic group, bigger than baby boomers. They're driving the market right now. And then we had really, really poor underwriting standards. You know, you could put 0% down to buy a house.
Right.
Poor FICO scores. I remember seeing 600 credit scores. Stated income, we now call those liar loans, right? Where you don't really make the income that you say. And then we had what we call neg-am loans, okay? And this is back, I think, where the ARM interest rates, ARM programs got a bad name because these loans would allow you to pay less each month to pay down your mortgage. So in other words, each month your mortgage balance was going up.
Got it.
So this created a situation, right, where now this housing bubble popped. Values came down, let's say 10, 15%. You put 0% down. People own multiple houses, and then it created a negative feedback loop where people started foreclosing and letting the homes go, which then exacerbated the entire system. So that was all caused on housing. This is a different time. You know, this is not caused by housing. Mortgages are very if you've been through it, right? They're I don't want to say there's no easy loan, but you know,
they're rigorous.
It's rigorous, right? We look at everything. I mean, it's full body cavity when we go through these things. People are putting down payments. Most homes are owner occupied right now. Your average American has 50% equity in their housing, and if you bought a house or refinanced a year and a half ago, you got interest rates in the low 3s, mid 2s. These people are not going to foreclose on their homes.
Right.
So we got a strong floor underneath the market. So could we see some softening? Okay, yes. Could we see some pullback? Yes. Are we heading for a crash? No. So I like that you used the word softening because, you know, all this news out there, and they've been saying it since 2015, 16, every year the market's going to crash. It's going to crash. We're in a housing bubble. This is what sells.
This is what makes you all pay attention. Right. This is all what scares you. If there's anything we've learned, the media is fear-based in all aspects of our lives. So that's why we've taken the time to really come and give you the real facts. There are so many different scenarios happening right now that does not equate to 2008. We have inflated, our prices have gone up significantly since that time, okay? 2008, 2009, 10, where we're at today, even if we correct a little bit, most of the people are sitting on equity, in addition to the fact that they're basically getting free money at 3%. So a lot of the people that bought at that time may not have to sell right now. So if the buyers want to come in and take advantage of what's happening, people who are on the market and need to sell their homes clearly need to sell. Otherwise, they would wait. So you can use that as leverage to get a property that you may not have been able to get in this market 6 months ago. And we're going to talk about other opportunities that buyers have in this market, because what this is about, guys, is about managing money, okay? This is not to be in fear. Rates going up and down, this is normal. So what you need to learn is, how do you manage your money? How do you build your wealth? Because people who have money, they're not in fear. They're waiting, okay? So this leads me to the next question. How do you mitigate high 30-year fixed rates? What are you seeing? What's a lot of the programs you're offering to clients now?
You know, I think we're getting back to a lot of these programs that we had before, you know, the last mortgage crisis, which are adjustable rate mortgages.
Okay.
Again, adjustable rate mortgages got a bad rap after the meltdown, but for most people who actually had adjustable rate mortgages, rates went down.
Okay.
So your ARM rates were actually really, really good.
So in order to just speak more in layman's terms to our audience, because not everybody is as savvy as we are when it comes to lending, okay? And they're like, ARMs, you know, what is all that? So an adjustable rate mortgage means that basically you are borrowing for a shorter amount of time. Right now, the 30-year fixed rates are set at what? What is our rate today on a 30-year fixed? Hovering at?
probably the low to mid sixes.
Low to mid sixes. Whereas on an adjustable rate mortgage, you're not doing a 30-year fixed, but you're dropping into a shorter term, 5-year, 7-year, 10-year term. And this term costs you less. So what are some of the adjustable rate mortgages you're seeing right now? Some of those rates?
Probably in the low to mid fives.
Low to mid fives. So you can actually save a point in borrowing right now if you were to go with an adjustable rate mortgage. Now, what does this mean? This means that down the line, when the economy changes and they see that inflation has been reduced and now they want to pump more energy back into the system, they're going to lower the 30-year fixed rates to get people back into the game. And when they do that, you go and you refinance, right?
That's right.
What does a refinance look for people? What look like for people? Is this something that's costly? How much do they have to anticipate? Do they have to go through more rigorous applications to make sure that they can refi at that time?
Great question. Same. A loan is a loan.
Okay.
Look at your income, make sure the value's there, look at your credit. In terms of cost, it's less expensive. Purchases are more expensive. I'd say refinance is probably maybe a third of the cost of a purchase, third to half the cost of a purchase.
And usually to purchase a loan and the costs that go with that, you're looking about 1% of whatever your purchase price is. So for every $1 million that you're spending, you're going to assume your loan cost may be hovering around $10,000. Correct?
So, and on a loan of that size, the refinance would be lower.
Okay.
Right? It's probably closer to 3,000 to 4,000. Look, these are just rough numbers.
Okay, so if we're in the Los Angeles market and we're hovering at about $1 million for properties here, then you're looking at about $3,000 to $4,000 per million to refinance your property. So look at that. I mean, you can save. How much does one save when they're saving 1%? You can save $1,000 a month.
Yeah, quite a bit.
Quite a bit a month. So it's really about managing and leveraging the debt, okay? This is where we have to change our mindset and how we look at money. This is not a time to be in fear, to be scared. This is a time to actually take heed on the opportunities. Buyers have been priced out of markets. They've been in insane multiples. They've had to go into, risk-free deals. I mean, it has been bananas. So for all the buyers out there, do not be in fear. If you are somebody who needs to buy, your family is growing, you want to put, if you're sitting with over 6 figures in your bank account and you are renting, you are already doing the wrong thing. Renting is throwing money away. So if you want to know how to take heed on the market and make this market work for you, then you need to look at money from a different lens. And that's another reason why we're here today. So what do you say to those people who are getting all these people talking in their ear about the market crashing and that they shouldn't buy at this time and that, they should wait for the market to drop even more? I know that people are waiting for the market to drop, but as the market drops, the rates continue to rise. So it's like, where is that balance? Because you're either paying more for lending and you're getting a better cost on the house. I mean, what do you really have to look at? I think that you shouldn't really be focusing on the price. You should be focusing on what it's going to cost you monthly. So give us a little insight or what your thoughts are on where you see this market going, and what you say to people who are being told now is not the time to buy and the market is crashing.
Well, again, that's a big question, right? I think first you got to look at your motivations. Like, why are you buying this house, right? I mean, housing is a fundamental need. You got to have a place to live. And then you talk about, well, what's the best use of your money, right? When it comes to having your place where you're living, right? Rent, like you said, you're just, money's like oxygen, right?
Yeah.
You breathe it in, you breathe it out, right?
Right.
You just need it to live. But when you're buying a house, right, you're actually paying down that debt and you're building equity. Over time, I guess the first thing would be if you're buying this house to occupy this house is your principal residence, right? You're buying it for lifestyle. You got needs, you got family, you got whatever it is that you need. There's a reason that you're buying this house. And I think it's more important finding a house that you like, because over time, these values are going up no matter what. When you look
let's talk about that. You think that over time values are going to continue to go up, even though we're correcting right now? You think that in 5 to 7, 10 years, we might see these prices continue to rise again?
Well, the only way you can have any idea what's going to happen tomorrow is by looking at what happened yesterday.
Okay.
Right? So, in the West, and I wish I had a graphic for you,
That'll be on our next videos. You know, this is video 1.
Right.
Okay, we're very early in our stages. This is the first time we've done this, first time we're meeting, and the first time we're doing a video. So I'm going to give ourselves some pat on the back. Give us a little pass on this.
Well, houses have gone up in the West, something like 300 and some odd %. So this is over a long period of time. So values are going to go up. And for most people, most Americans, people who earn less than $200,000 a year, you know, housing is still the bulk of most people's wealth, right? I mean, we don't have pensions anymore. 401k is what, 19 grand a year. And so your house is your biggest investment. So, you know, if you're buying this house for an extended period of time, I mean,
it's a no-brainer.
Well, then also think about this. I mean, how much do you really save? So for $1 million house, how much does it cost to rent that $1 million house in LA?
Right now, I want to say at $1 million house, I mean, I'm getting, you know, the rental market is high. So I would say 6,000.
Okay, so 6,000 times 12, that's $72,000
a year.
So then if you say rent for a year and a half, so that's $72,000, $108,000.
$108,000.
So then you think about that. You think about whatever tax breaks you may have for that. Most people, let's say 30% tax break. So
explain to me what you're saying on tax break.
Well, I want to be careful.
People, we gotta, you know, they don't know. This is not their area of expertise, right. Well, Johnny. We gotta talk real chill, okay?
Well, essentially, the interest you can deduct off your income.
So what you're talking about is the owning versus the renting. When you're renting, paying $6,000 a month in rent, you are throwing away $72,000 a year. Renting is just not the way to go. But if you're like, let me go find a house and it's costing you $6,000 a month in mortgage, okay, well now that money is going back into your investment. Your home, if you find one where you can build equity and you can put money into it and value add, now it's building equity. You also have tax deferment for interest. So the interest that you pay is a write-off.
If the value of the house goes down 10%, let's say it goes down 10%. So your $1 million home is now worth $900,000. Okay. But if you wait a year and a half or you wait a year, you spend $72,000. So the question is, how much are you really saving? I don't know. You know, we also have a massive housing shortage.
Yeah.
They're not building any more homes.
Yeah.
And
we have way too many people to houses. So therefore, this is another piece of the Los Angeles market that may be different from other markets, is that we don't have enough housing here. There are properties still moving in multiples, guys. It's all about pricing, how you're approaching the market, and the product that you're presenting to the market. So, you know, there's many variables still moving. John, how many loans do we have currently in play, you and I, right now? I think we have two or three loans. Him and I, we currently have two to three loans in play right now with our buyers. So we're still in a market where, you know, people have to sell. I'm in a deal right now where the sellers are getting divorced and they have to sell. I'm in a deal where my buyers have babies and they're upgrading and they need bigger space. So going back to what you say, home is fundamental. And no matter the market, there are always going to be homes for sale and there's always going to be buyers. Okay. So how are you going to take advantage of that? Well, I think we covered a lot today. I don't know if I haven't thought about anything, but maybe I'll make it a point to come out here once a month and see you, Johnny, and we can talk about what's happening in this lending world. Thank you so much for your time. It's an absolute pleasure to meet you in person. A lot better looking than I thought. And we'll be back for more lending updates. And if you have any questions, please reach out to me directly because I have so much information to share. And as you know, follow my lead and you shall succeed.